Welcome back to the second half of the Future Show here on the TD Ameritrade Network. We're less than 60 minutes away from the cash open for stocks on Wall Street. Let's check in on futures and see where things stand. At the top of the show, we pointed out how we were fractionally higher in the four majors. It's been kind of a mixed overnight session, though, as international markets reopened after Easter holiday. And, well, there you can see the ES, the NASDAQ, the Dow, the Russell still enjoying small gains. Nothing major in terms of momentum or directional conviction one way or the other. For the most part, very much range-bound in the overnight session. Let's check in on some of the other top-traded products in terms of the U.S. dollar. We were talking about some of the strength we've seen there. And, well, as you can see, it's holding on to positive territory. Look at gold. Just below that 2,000 level, briefly traded above it yesterday, 2003. It's at 1981 right now. Gold is at 105 and the VIX at 2270. All right, we just had some housing numbers come across the board here, and for the most part, it looks like that continues to remain a, well, pillar of strength, beating expectations, topping prior levels, and, well, across the board, it looks like revisions to the upside in terms of housing starts and building permits. Let's bring in Scott Bauer, the CEO of Prosper Trading Academy. He's joining us to take a look at the data due out. Scott, we've been talking about a headline-driven market and how the focus is on eco data with rates on the rise. There's been some concern about the ripple effect that can have on housing. It doesn't seem to have really slowed some of that momentum. These numbers oftentimes looked at as forward-looking indicators and suggesting that we could see some pretty good data this spring as well.
So my question is, Ben, when is this going to catch up, right? I mean, looking at rates and looking at inflation, and yet we get these, as you said, pillar of strength here with these housing numbers. This new number today, it blew expectations away. Estimates were for a decline, like a 2.5–3% decline or so, and we got a rise. So it's actually incredible what is going on in the housing market. We all know it. Prices are 20% higher than where they were last year, and that's with rates almost double. If you will, whether you're someone wants to take out a 5, a 7, a 30-year mortgage rate, it's absolutely incredible what is going on. I mean, I have friends, I'm sure you do as well, in the market, both on the sell side and on the buy side. Any house, any condo, any property that's listed is going for 5, 10, 15% above asking price. It's just crazy.
Scott, we've been kind of talking about trends, and this is being one of them. We've talked about, for example, the yen, the euro currency, the dollar, and how these trends, which are long in the tooth, oftentimes as traders, you kind of want to fade them. But in this instance, again, this has been one that's continued to remain present. And just along those lines, though, I mean, when the market or trends like this reach these extremes, oftentimes they do pull back, but it can take a little while to that point here. And by definition, we talk about extremes in terms of not spending a lot of time on those levels. But in this instance, we have.
We absolutely have. And we have not seen those pullbacks as much as, many of us may say that, you guys were just talking about the 10-year and how oversold it is. And yet it's not pulling back whatsoever. We're almost touching 3% here. The dollar, the strongest that it's been in quite some time, especially versus the yen. I mean, it's what, a 20-year high versus the yen right now, and yet the momentum there, Ben, is just unbelievable. It is unbelievable momentum, and as you said, as a trader, you really want to fade these moves. I mean, our inherent nature is to fade these moves, and it's so difficult to right now.
Yeah, and, oftentimes a mistake as well. I kind of look at it as we always joke about picking up nickels in front of a steamroller if you're trying to counter trend some of these moves, or basically just trying to pick a bottom, which oftentimes can be very not only emotionally frustrating, but also costly at times. So, the problem here is that you have a hard time participating when the market's overextended like this. But, we've talked about how you just have to kind of grab on and hope that it continues. Talk to us a little bit about, Scott, these inflationary pressures and how, well, ultimately the impact they've had on the indices, rates on the rise, consumer discretionary spending seems to be down with prices at the pump up. Talked about natural gas doubling since the beginning of the year. I mean, we're going to hear from companies this week, which will provide a little bit of insight. Netflix this week, for example, maybe will be the unfortunate beneficiary of some of that spending constraints that consumers have been feeling.
It'll be interesting because, we got through all the financials or the big financials. And one that stood out to me, a comment that stood out to me yesterday with Bank of America was they didn't raise guidance. However, they reiterated what their guidance was. And that was good enough for the market to really take hold of that. And we saw what the financials did yesterday. So I'm curious, to your point about Netflix, some of the other consumer staple, if you will, stocks, what they're going to say going forward. It's absolutely going to be, the result of earnings is absolutely going to be in what the guidance is. And is the pullback, as the consumer starts to pull back because of the inflationary pressures, are we going to see those stocks like a Netflix, maybe even lower guidance? So I think that is going to be so key to watch here. And Netflix could really be a barometer for the entire earnings deluge that we're getting over the next few weeks.
I like that. And, we were talking about the indices at the top of the show and a bit of a holding pattern, not a lot of directional conviction overnight is, well, partially I think international markets closed for the holiday yesterday. Everybody's just kind of getting things started there for the week, but also, again, into earnings and some of the data due out. Fed Chair Jerome Powell is going to speak a little bit later on this week. Let's talk a little bit about treasuries, Scott, and what you've been watching there. One thing I've been keeping an eye on is the longer end seems to really be accelerating. We've been watching the bonds to the downside here. Actually, let's take a look at the futures here. Obviously, when we're talking futures to the downside, as we just brought to our viewers' attention with Rick, and we were looking at the 10-year, you're talking rates to the upside, but this has been a well-defined trend as well, one that's long in the tooth again. But if you faded this, you've been on the wrong side and trying to pick a bottom, a guessing game. If you've been participating in it, even though long, you've been rewarded just for enjoying, again, or hopping on the side of the trend. As they say, it's your friend. I always like to say continuation more likely than change.
It is. And now, as you said, the long end is starting to pick up. For about 4 weeks or so, we saw a big divergence between that shorter end and the long end. The long end is making up for some lost time now. So with all of the hawkish tones coming out of the Fed and what Bullard was talking about yesterday, we're going to see a continuation here, Ben, at least through, in my opinion, at least through that May meeting. We're going to see such speculation what the Fed is going to do. It's not even a question anymore of whether it's 50 points, it's whether it's 75, and there's some talk now that it may even be a full point hike, a 1% hike. I don't know that that's going to happen. I think that would be too much of a shock to the system. But the CME FedWatch tool, which is something I watch very closely, is now propping up the odds of a 75-point hike. So, it's for the next 4 weeks or so, 3.5, 4 weeks until that Fed meeting, that volatility is going to stay. And I think that you have to be on the side of the trend.
Let's take a look at the trend here in terms of what we've seen as far as treasuries to the downside, the bonds lower. We were just looking at the data and again suggesting that we could continue to see rates to the upside here, Scott, with strong housing numbers. Now, this is a look at the longer end. Again, the bonds on the left down to 139.13 yesterday to begin the week. The 10-year participated, just barely holding on to the 119 handle. I want to point out here, you can see the 2-year has been, 2-year on the right, the 5-year on the left here. So they did not post new lows this week as of yet. And just quickly pointing out here, rates to the upside, the 30-year on the left, the TYX at 2.99, just shy of 3%. And look at the TNX above 2.9% here. Scott, in terms of the yen, we've seen weakening. We talked about some of the strength in the dollar, but there's been other foreign currencies that are worth mentioning here. And before we let you go, I wanted to get your thoughts on the British pound, for example, coming off. The euro with a hawkish tone, a dovish tone from the ECB last week, leaving rates unchanged. The Swiss franc I saw into lows as well. I mean, we've been seeing multiple currencies which are, again, fueling this move up in the greenback. It's not just strong data here, rates on the rise, and the Fed expected to raise rates at the upcoming May meeting. Now even Bullard's calling for 75 basis points.
Absolutely. And look at the Swiss franc, one that typically doesn't move a lot with the dollar here. And we're seeing that, around 90, mid 94s or so. It's not anywhere near where it was in January 2019 when it was up at 101, but yet it is still so weak compared to the dollar. And when you take a deep dive into it, we're so hawkish here, and the expectations are for these quick and violent rises, rate hike, if you will, from the Fed. When you look at other currencies, whether it's the yen, Swiss franc, euro, pretty much all of them you mentioned, they're not talking about being as hawkish as we are here. And that's why you're seeing just a massive, massive divergence and strength in the dollar versus these other currencies. Looking across the board, maybe the Aussie dollar is recovering just a little bit here because now they're starting to talk about getting a little bit hawkish. But across the board here, you're not seeing the reaction to certain Feds in the world, economically across the world here as our Fed is here.
Well, I think some of the Asia-Pacific currencies are dealing with concerns related to China. Now, we did see the RBNZ last week. I think it was, as far as I remember, up 50 basis points. So, again, the first time they had done that, I think, in 2 decades. So we were talking about if we see a 75 basis point rate hike here in the U.S., we haven't seen that since 1994. And I think in that cycle, we raised something like 300 basis points. So goes to show you when the hawkish Fed comes to town, again, treasuries are headed down, I guess, is the best way of thinking of it. I didn't have anything better than that, Scott. But all right, we'll let you get out of here.
Listen, Ben, sometimes less is more, and you hit the nail on the head with that.
I should take your advice. Appreciate you joining us this morning. Scott Bauer from Prosper Trading Academy. Always a pleasure to have you on the show, and we'll keep an eye on some of the currencies and financial markets here per Scott's comments. And